What's up traders, welcome back to another video, and in this video I'm gonna be talking about market structure. If you're struggling to read price action and getting caught up on the wrong side of the market, it's time for you to master market structure. And in this video I'll break down the market structure step by step so that you can trade with confidence. Let's dive into it. What is market structure? Market structure is simply how price moves on a chart, and that's the foundation of price action trading, and it tells us whether the buyers or the sellers are in control. So instead of using an indicator, smart traders use market structure to identify trends, reversal, and high probability trade setups. I'm going to show you how a trend is formed, and even if I ask you to show me an uptrend or a downtrend, I'm pretty sure you'll be able to show me, right? All right, let's take a look at the chart, right? If I were to ask you to write to draw me an uptrend, you show me something like this, right? That's a high, this is a low, this is a higher high, and this is a lower low, and this is a higher high, and this is a lower low. And as long as the higher high is being formed, we're in an uptrend, correct? Right. So, well, a trending market moves in waves. It always creates a higher high and a lower low, and they swing highs and swing lows. So, if you're looking at an uptrend, all you gotta look for is that there's always a higher high that is being formed, right? These are the higher highs right here. These are the higher highs, and these are the lower lows. If it doesn't break the lower lows, this is considered to be an uptrend. Now, if it's a downtrend, and I will draw it for you, it will create a lower low, a lower high, a lower low, a lower high, a lower low, and a lower high. It always forms this formation. So there's always a lower low being formed and a lower high that is being formed. If it breaks past the lower high, then it's no longer a downtrend. Now we got the third one, that is when price is ranging or when it's consolidating. That means price is moving sideways. It's going nowhere. It's playing between a support and resistance, and this becomes annoying when you're looking at it at a chart. So market structure helps us traders in the direction of the trend, and it helps us to avoid unnecessary losses. You do not want to be entering when the price is consolidating. Granted, there are trading strategies that you can trade in consolidations, but the big traders and the smart money, they like to follow the trend. Following the trend is your friend. Why is market structure important? Many traders rely on indicators, and I also used to rely on indicators too. I used to use moving averages and RSIs, but they lag behind price. Like for example, the chart to your right, that's a chart that has moving averages and RSIs. It has indicators on it. And market structure is pure price action, allowing traders to make real-time decisions. That's the chart to your left. So looking at the two, you can see that the chart to your right has quite a lot of noise on it, and the chart to your left is just clean, pure candlestick formations. Nothing added, nothing more. So market structure kind of helps us to identify the trend direction, to spot reversals before they even happen, to find best entries and exit points, and avoid getting trapped by market makers. Like for example, if you ever entered a trade, right, and it broke out and only the price to reverse on you, that was because the market structure wasn't confirmed. The three main market phases. So like I showed you earlier on, our uptrend is formed. This is what it will look like in a chart. So this is Euro USD at 1 hour, and this is what an uptrend look like. So if you're looking at it by higher highs and higher lows, this is a higher high, a higher low, a higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, until it's at where it's at right now. So the market structure would only shift if this low gets taken out. So let's say the market continues to play out and creates a pattern like this, then we've changed direction to the downside. Now we're looking at a downtrend, a bearish market. So it creates lower lows and lower highs. Sellers are in control. The best strategy is to sell on a pullback to a lower high. So on this chart again, Euro US dollar 1 hour, we have our high right here where we created our lower low and our lower high. Around here you would sell, and the lower low got created, lower high, sell, lower low got created, a little pullback, lower high, sell, lower low, lower high, lower low, lower high. This is a downtrend, and the only time that the downtrend would be in a reversal or a change of market structure is occurred is when this area right here gets taken. Now let's talk about consolidation. As you can see on this Euro US dollar 1 hour chart, the price is moving sideways. It doesn't have any clear direction that it's going, and the best strategy to trade this is to either wait for a breakout or you trade off of the bounds of the support and resistance. So every time it takes this areas, you could have sold, and every time it tagged around here, you could have bought. But the best way is to wait for a breakout like what happened here, and then you have a clear chance. Common mistakes traders make with market structure. Mistake number 1: entering a trade without confirming structure. You always need to confirm structure before you enter a trade. So the solution to do this is to always wait for your break of structure, which is your BOS, or your market structure, which is your MSS, before entering a trade. Mistake number 2: confusing pullbacks with reversals. Right, the solution here is a trend is only broken when previous swing levels are violated. We talked about this. If you're in an uptrend, we got higher highs and higher lows, and if you're in a downtrend, we got lower highs and lower lows. Mistake number 3: ignoring the bigger picture. Multi-time frame analysis. I cannot stress this enough. I have so many trader friends that I always talk to them and ask them why don't you look at a bigger time frame to just at least have a bias, have at least a directional bias for the day. But they say, nah, I would rather stick to my 1 hour 15 minute, and I live it like that. Hey, if it's good, if it's working for you, it's working for you. But it's a mistake. You need to look at a 4 hour or a daily before you trade the small ones, so that you get the bias. Anyway, comment down below if you ever have any of these mistakes before. Let's learn together. Yeah, cheers. Now that you understand market structure, it's time to apply it in your charts. If you find this helpful, make sure you like, subscribe, and hit the notification bell so you don't miss any of my next videos. Comment down below which topic you would want me to talk about next. Happy trading. Peace.